In all my years of studying markets and counseling investors, I've observed something peculiar about human nature. We learn our most valuable lessons not from our successes, but from our failures. And if there's one truth I've discovered across decades of investment experience, it's this: the most important lesson money can teach us comes not from making it, but from losing it. I want to share with you today what I consider the central insight of intelligent investing, and I promise you, it's not what most people expect to hear. It's not a secret formula for selecting winning stocks. It's not a method for timing the market. It's something far more fundamental, something that touches on the very nature of how we think about money, risk, and our own psychology. The lesson is this: most investment losses are not failures of analysis. They are failures of temperament. Let me explain what I mean. Before we go further, we must be absolutely clear about the distinction between investment and speculation. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Notice that I said thorough analysis, not a hunch, not a tip from a friend, not excitement about a new technology or a booming industry. Analysis. Yeah? Now, there's nothing morally wrong with speculation, provided you understand that's what you're doing and can afford the potential losses. But the tragedy I've witnessed countless times is the speculator who believes himself to be an investor. He buys stocks without understanding the underlying businesses. He follows the crowd during manias. He confuses the recent past with the predictable future. And when the inevitable reversal comes, he's shocked to discover he was gambling all along. Okay. I learned this lesson myself, though I wish I'd learned it more cheaply. In my earlier years, before I developed the principles I now hold dear, I made purchases based on incomplete analysis. I allowed enthusiasm to override arithmetic. I mistook a rising price for a sound investment. The market has a way of teaching such lessons with brutal efficiency. Let me introduce you to a character who has helped me understand market behavior for many years. I call him Mr. Market, and you should think of him as your business partner in a private enterprise. Every single day, Mr. Market appears at your door and names a price at which he will either buy your interest in the business or sell you his interest. Here's the crucial thing about Mr. Market. He is emotionally unstable. Some days he's euphoric, seeing nothing but opportunity ahead, and he names a very high price for the business. Other days he's deeply depressed, seeing nothing but trouble, and he'll name a very low price, a very low price. The more manic depressive his behavior, the more opportunity you have to profit from his irrationality, but only if you maintain your own emotional equilibrium. Most investors I've found make a fundamental error in their relationship with Mr. Market. Instead of taking advantage of him, they let him guide their own emotions. When he's euphoric and prices are high, they become euphoric too and buy eagerly. When he's depressed and prices are low, they become depressed and sell in panic. They let the servant become the master. The lesson I learned from my losses was this, Mr. Market is there to serve you, not to instruct you. His job is to provide you with opportunities for purchase and sale. Your job is to ignore him completely, except when his prices serve your interests. If he shows up offering to buy your share of a wonderful business for twice what it's worth, by all means sell to him. If he offers to sell you his share of that same business for half what it's worth, by all means buy from him. But if his price doesn't make sense either way, ignore him. He'll be back tomorrow with a new quote. The investor who lost money, as I did in my early experiences, was the one who thought Mr. Market was providing information rather than opportunity. I thought rising prices meant I was right to buy. I thought falling prices meant I should sell. I had confused price movement with investment merit, and the market extracted tuition for this misunderstanding. After learning this lesson the hard way, I became obsessed with a single question: how can an investor protect himself from serious loss? The answer I arrived at after much study and reflection became the cornerstone of my investment philosophy. ASAV. I call it the margin of safety. The margin of safety is the difference between the price you pay for a security and its intrinsic value. It's your cushion against error, misfortune, and the unexpected. It's the principle that allows you to make mistakes in your analysis and still not lose money. Okay, let me give you a concrete example. Suppose you're considering a bond issued by a corporation. The company has been earning, on average, $5 for every dollar of interest it must pay on all its bonds combined. That's a 5-to-1 coverage ratio. Now, the company could suffer a severe business decline, cutting its earnings in half, and it would still be earning 2.5 times its interest obligations. That cushion, that extra earning power beyond what's needed, is your margin of safety. In the stock market, the margin of safety comes from buying at a price substantially below your estimate of intrinsic value. If you calculate that a business is worth $50 per share, paying $60 gives you no margin of safety at all. Paying $40 gives you a 20% margin. Paying $30 gives you a 40% margin. The larger the discount from value, the greater your protection against loss. Here's what I learned from losing money. I had been buying stocks without any margin of safety at all. In some cases, I was buying at prices that exceeded even optimistic estimates of value, carried away by the enthusiasm of the moment. I was paying $1 for 50 cents of value simply because the price had been rising. The market's eventual correction was not bad luck, it was inevitable arithmetic. The mathematics of loss and recovery taught me another crucial lesson. If you lose 50% of your capital, you must gain 100% just to break even. Lose 70% and you need a 233% gain to recover. These are not attractive odds. Prevention of serious loss must therefore be your first priority, ranking even above the pursuit of gain. Most investors view market fluctuations with anxiety. They check prices obsessively, growing agitated with every decline. But I've come to understand that for the true investor, someone who will own stocks for years rather than months, fluctuations are an opportunity, but not a punishment. Consider a simple example. You own shares in a fine business, something like a well-established utility company serving a growing region. The business earns steady profits, pays regular dividends, and increases its value slowly over time. Now suppose the stock market closes for 5 years. Does this affect the value of your investment? Not in the slightest. The business continues operating, continues earning, continues growing in value. But because the market remains open and prices fluctuate daily, most investors cannot maintain this business-like attitude. They see their quotational losses and feel they must be real losses. They forget that they own a piece of a business, not a piece of paper whose only value is what someone will pay for it tomorrow. The lesson I learned from my losses was that I had been treating fluctuations as information rather than opportunity. When prices rose, I thought this confirmed the wisdom of my purchase. When prices fell, I thought this indicated an error. But in both cases, I was wrong. The price fluctuations were telling me nothing about the underlying business value. They were merely presenting opportunities to buy or sell if the divergence from value became extreme. So, let me share something from my teaching experience at Columbia Business School. I would often ask students to imagine they owned a small apartment building worth, let's say, $100,000 based on its rental income. Now suppose someone began shouting prices at them every day: 80,000, 120,000, 70,000, 140,000. Would they feel richer on the high price days and poorer on the low price days? Would they sell the building for 70,000 just because that was the quoted price? Of course not. They would recognize these quotes as irrelevant to the building's actual earning power and value. Yet, this is precisely what the investors do in the stock market. They own small pieces of businesses but treat them as gambling chips whose value is determined by the last trade. The emotional toll this takes is severe, and it leads directly to the behavioral mistakes that cause losses. I want to emphasize a principle that took me years to fully appreciate. You are not buying a stock, you are buying a proportional interest in a business. This distinction may seem subtle, but it's absolutely fundamental to investment success. When you buy 100 shares of a company, you become a part owner of that enterprise, entitled to your proportional share of all future earnings. If the company earns $1 million and has 1 million shares outstanding, you own 1/10,000th of those earnings, or $100 worth. This is true whether the stock price goes up, down, or sideways. Your ownership stake in the business's productive capacity doesn't change just because Mr. Market changes his mind about what he's willing to pay. Okay, the losses I experienced early in my career came from forgetting this basic truth. I would look at price charts, at momentum, at what others were buying. I wasn't asking the fundamental questions. What does this business do? How does it make money? What are its economic characteristics? What gives it competitive advantage? Is management capable and honest? Are the financials strong? In the years after the Ichenjobite Arsajo crash, I spent considerable time studying what had gone wrong. The businesses that survived and eventually prospered were typically those with strong balance sheets, low debt, consistent earnings, and competitive advantages. The businesses that failed were often heavily leveraged, dependent on continued access to credit, or operating in industries with destructive competition and no barriers to entry. Yet, during the mania of the late Ichenjobite Arsas, investors ignored these distinctions. They bid up on sound companies alongside sound ones, often pushing the weakest companies to the highest valuations based on nothing more than excitement and momentum. When reality reasserted itself, the losses were catastrophic. Okay, I learned to ask, if the stock market closed tomorrow for 10 years, would I be happy owning this business? If the answer was no, I had no business buying it regardless of what the price chart looked like. Okay, let me spend some time on a concept that's central to intelligent investing, the relationship between intrinsic value and market price. Intrinsic value is what a business is actually worth based on its assets, earnings, dividends, and future prospects. Market price is what others are currently willing to pay. These two numbers can diverge substantially, and that divergence creates both opportunity and danger. Calculating intrinsic value requires judgment. There's no formula that works in all cases. For a bond, value comes primarily from the certainty of payment and the interest rate compared to alternatives. For a stable business with predictable earnings, you might estimate value by calculating what stream of future cash flows, discounted to present value, the business will generate. For an asset-heavy company, book value might provide a floor estimate. Now, the key insight is this: intrinsic value is relatively stable, changing slowly as business fundamentals evolve. Market price, however, can be wildly unstable, swinging from extreme undervaluation to extreme overvaluation based on crowd psychology. I lost money when I confused the two. I would see a stock trading at $50 and assume it must be worth approximately $50. Or why else would rational market participants be trading it there? This was a grave error. The market is not efficiently valuing securities at every moment. It's a voting machine in the short run, reflecting popularity and emotion. Only in the long run does it become a weighing machine, reflecting actual business value. Consider the experience of Ichenjobite Sansarar. The depth of the Great Depression. Many wonderful businesses could be purchased at prices below their net current assets, meaning you could buy the company for less than its cash, accounts receivable, and inventory, getting the factories, brands, and earning power for free. These businesses hadn't become worthless, the market had simply become paralyzed by fear. Conversely, in Ichen Jubait Arsajul, you could hardly find any bargains at all. Nearly everything traded at inflated prices relative to earnings and assets. The businesses hadn't all become extraordinary. The market had simply become intoxicated by greed. The lesson, price is what you pay, value is what you get. They are not the same thing, and intelligent investing requires you to distinguish between them constantly. I've spent considerable time studying the psychology of investing, both in others and in myself, and I can tell you with certainty that emotion is the enemy of investment success. Not emotion in general, you understand. Emotion makes life worth living. But in the specific context of investment decisions, emotion leads almost inevitably to error. The pattern repeats endlessly. Prices rise and investors become optimistic. They extrapolate recent gains into the indefinite future. They convince themselves that traditional valuation metrics no longer apply. They tell themselves this time is different. They begin to fear not the loss of capital, but the loss of opportunity, the chance that others are getting rich while they stand aside. So they buy, often at the worst possible moment, then reality intrudes, earnings disappoint, a crisis emerges, prices fall, sometimes dramatically. Now, the same investors who are buying with enthusiasm find themselves paralyzed by fear. They extrapolate recent losses into the indefinite future. They convince themselves that further decline is inevitable. They fear the loss of what little capital remains. So they sell again at the worst possible moment. This fear and greed cycle is not a bug in the system. It's a feature of human nature. We evolved in environments where quick emotional responses to threats and opportunities improve survival. But these instincts serve us poorly in markets where the crowd is often wrong at extremes and where the best opportunities often feel the most frightening. Kinka, the losses I experienced taught me that I needed rules, principles, and a systematic process to protect me from my own emotional impulses. I needed to do my analysis when I was calm and rational, not in the heat of a market move. I needed to establish purchase and sale criteria in advance, not in response to price action. I needed, in short, to become my own Mr. Market, offering prices to myself based on value rather than emotion. Okay. Now let me address a principle that's often misunderstood, diversification. Some investors believe that if they've done thorough analysis, they should put all their capital into their single best idea. This view has a certain logic to it, but it ignores a crucial reality. We are all ignorant, and diversification is protection against that ignorance. No matter how thorough your analysis, you cannot foresee all future developments. A trusted management team may prove dishonest. A seemingly strong competitive position may be undermined by innovation. A regulatory change may destroy profitability. An unexpected economic shock may impair the business in ways you couldn't anticipate. If you've concentrated your capital in a single security or a handful of securities, any one of these unexpected developments could result in catastrophic loss. But if you've diversified across 10, 20, or 30 well-selected securities, an unexpected failure becomes merely disappointing rather than devastating. I learned this lesson through experience. When I concentrated capital based on conviction without adequate diversification, I exposed myself to risks that analysis couldn't eliminate. The losses that resulted taught me humility. I came to understand that diversification wasn't a confession of ignorance. It was wisdom about the limits of knowledge. That said, diversification must be intelligent, not random. Buying 100 different stocks doesn't protect you if they're all overvalued or all in the same industry or all subject to the same economic forces. Meaningful diversification means owning businesses with different economic characteristics, serving different markets, affected by different factors. For the defensive investor, the one seeking safety and reasonable returns without extensive analysis, I recommend diversification not only across individual securities, but across asset types. A mixture of high-grade bonds and diversified common stocks provides protection against various economic outcomes. If deflation threatens, bonds do well. If inflation emerges, stocks provide some protection. If economic stability prevails, both do reasonably well. This brings me to an important distinction I developed over the years. The difference between the defensive investor and the enterprising investor. The defensive investor is primarily concerned with avoiding serious mistakes and losses. He wants adequate returns without extensive effort or specialized knowledge. The enterprising investor is willing to devote time and intelligence to seeking superior returns. Most people should be defensive investors. This isn't an insult to their intelligence. It's a recognition that successful stock selection requires time, knowledge, and temperament that most people neither have nor wish to acquire. The defensive investor can achieve perfectly satisfactory results through a simple strategy, maintaining a diversified portfolio of high-grade bonds and leading common stocks, rebalancing periodically, and ignoring market fluctuations. The losses I witnessed in others and experienced myself in earlier years often came from defensive investors trying to act like enterprising investors. They would attempt stock selection without adequate knowledge. They would try to time the market without adequate skill. They would trade frequently, generating costs and taxes while adding no value. They would have been far better served by accepting average returns through a simple, systematic approach. For the defensive investor, I recommend something like this. Maintain perhaps 50 to 75% of your capital in high-grade bonds or similar fixed income securities. Place the remainder in a diversified list of leading common stocks, perhaps 10 to 30 companies representing different industries. Rebalance annually or when the proportions shift substantially. Never sell stocks simply because prices have declined if the businesses remain sound. Never buy stocks simply because prices have risen if valuations have become excessive. Now, this approach won't make you rich quickly, but it will protect you from the serious losses that come from speculation, from trying to be clever, from following the crowd at extremes. It will allow you to sleep peacefully, which is worth considerably more than most investors realize. I must address a truth that many find uncomfortable. Most people who attempt to beat the market will fail, not because they lack intelligence, not because they lack effort, but because the market is a negative-sum game after costs, meaning that beating the average requires not just skill, but enough skill to overcome trading costs, taxes, and the advantage held by professional investors with more resources. Consider the mathematics. If everyone earned the market return before costs, then after costs, the average investor must earn less than the market return. The amount less depends on the cost paid. For active traders paying substantial commissions and taxes, the deficit can be severe. For passive investors using low-cost index funds, the deficit can be minimal. The tragedy I've observed is the investor who generates substantial returns in the market but gives them all back and more through excessive trading, poor timing, and the costs of activity. He would have been far better served by accepting market returns through a simple buy and hold approach. Right? The lesson I learned from my own losses and from counseling others through theirs is that humility is the beginning of wisdom in investing. The investor who knows what he doesn't know, who respects the difficulty of the task, who doesn't confuse luck with skill, is far more likely to achieve satisfactory results than the one who believes success is easy. If you have neither the time nor the inclination to become a serious student of security analysis, there's no shame in accepting this reality. Invest defensively and spend your mental energy on your career and life rather than on trying to outsmart the market. I want to emphasize the importance of bonds and conservative positioning. particularly as one grows older or when valuations become extended. There's a pervasive bias in American culture toward growth, excitement, and aggressive investing. But preservation of capital is not cowardly when circumstances warrant. Bonds serve several crucial functions in a portfolio. First, they provide stable income that doesn't disappear during stock market declines. Second, they preserve capital during periods when stock prices fall. Third, they provide dry powder to purchase stocks if prices decline substantially. Fourth, they allow you to sleep at night, which is essential for maintaining the emotional equilibrium needed for good decision making. Okay? I learned the value of bonds through the experience of the Great Depression. Investors who were entirely in stocks in Ichen Jubat Arsajul saw their capital decline by 89% by Ichen Jubat Sensurar. Even if they held on through recovery, the emotional toll was severe, and many sold near the bottom. Investors who held substantial bond positions maintained capital and purchasing power, allowing them to take advantage of extraordinary opportunities when they emerged. But the appropriate bond allocation depends on your age, circumstances, and market valuations. A young person with steady employment and a long-time horizon can reasonably hold a small bond position, perhaps 25. An older person approaching or in retirement should hold a larger bond position, perhaps 50 to 75%, prioritizing capital preservation over growth. Okay? Additionally, market valuations should influence your positioning. When stocks are cheap by historical standards, trading at low multiples of earnings with high dividend yields, you can reasonably hold a smaller bond position. When stocks are expensive, trading at high multiples of earnings with low dividend yields, prudence suggests increasing your bond allocation even if you're young. Before I conclude, I must address an enemy that works silently but relentlessly against every investor: inflation. Even moderate inflation of 3% annually will cut your purchasing power in half over 23 years. If you're earning a seemingly safe 5% on bonds, but inflation is running at 3%, your real return is only 2%, and taxes will consume some of that. This creates a dilemma for the conservative investor. Bonds preserve nominal capital but may lose real value to inflation. Stocks provide protection against inflation through growth in earnings and dividends, but they subject you to significant fluctuations in price. The solution I've developed is not to flee from bonds entirely, but to maintain a balanced approach. Hold enough bonds to provide stability and income, protecting against the deflation or depression that would devastate an all-stock portfolio. But hold enough stocks to provide growth, protecting against the inflation that would devastate an all-bond portfolio. The losses I've witnessed from inflation are less dramatic than market crashes, but no less real. The widow living on bond income who finds her purchasing power slowly eroded is suffering genuine financial harm, even if she never sees a market quotation decline. As I reflect on a lifetime of studying markets, investing capital, and teaching others, certain truths have revealed themselves as permanent, while others have proven temporary. The permanent truths include these: markets will fluctuate, human psychology will drive those fluctuations to extremes. Companies with strong competitive positions, honest management, and sound finances will generally prosper over time. Price and value will eventually converge, though the timing is unpredictable. Emotion will lead most investors astray most of the time. Diversification will protect against unexpected misfortune. A margin of safety will protect against errors in analysis. Patience will be rewarded more often than activity. The temporary elements include these: which particular companies dominate which particular industries, the level of interest rates and inflation, the popularity of particular investment styles, the technological innovations that seem revolutionary at the moment, the political and regulatory environment, the names on everyone's lips as the next great opportunity. The losses I experienced in my early career came from confusing the temporary with the permanent. I thought rising prices were a permanent feature when they were temporary euphoria. I thought particular companies were permanently dominant when they were temporarily advantaged. So I thought my own insights were permanently superior when they were temporarily lucky. The lesson ultimately is this: investment success comes not from predicting the temporary, but from understanding the permanent. It comes from recognizing that human nature doesn't change, that basic principles of business value don't change, that the mathematics of compound interest and return don't change. When you lose money in markets, and at some point everyone does, the question to ask is not what was wrong with my prediction, but rather, what principle did I violate? Did I pay too much relative to value, failing to maintain a margin of safety? Did I fail to diversify, exposing myself to unnecessary risk? Did I allow emotion to override analysis? Did I speculate when I thought I was investing? These are the questions that lead to learning rather than rationalization. These are the questions that protect you from repeating mistakes. These are the questions that over time transform loss into wisdom. I said at the outset that the most important lesson comes from losing money. Here is that lesson stated plainly: intelligent investing is not about being clever, about predicting the future, about finding the next great stock. It's about being systematic, about maintaining principles that protect capital, about understanding your own psychology and planning for your own fallibility. The investor who accepts this truth, who approaches markets with humility and discipline, who treats investing as a business rather than a game, who measures success not in single years but in decades, that investor will almost certainly achieve satisfactory results. And satisfactory results compounded over a lifetime will provide more than adequate wealth for any reasonable person's needs. But the market will continue to offer opportunities for those patient enough to wait for them and disciplined enough to act on them. Mr. Market will continue to oscillate between despair and euphoria, providing chances to buy low and sell high for those who maintain emotional equilibrium. The fundamental mathematics of value, growth, and compound returns will continue to work their magic for those who understand them. But none of this will help the investor who cannot control his own emotions, who cannot resist the siren song of easy riches, who cannot distinguish between investment and speculation. For that investor, the market will continue to extract tuition, teaching its lessons through the only method that ultimately reaches us: the loss of money. My hope is that by sharing what I've learned, perhaps some of you can avoid paying that tuition yourselves, or at least pay a smaller price than I did. The principles of intelligent investing are not complicated, but they are difficult to follow because they require us to act rationally when everyone around us is acting irrationally, to be patient when everything in our nature urges action, to be fearful when others are greedy, and greedy when others are fearful. If you remember nothing else from what I've shared, remember this: the market's purpose is not to instruct you, but to serve you. Your task is not to predict what it will do, but to determine what you should do based on facts, analysis, and time-tested principles. The losses will come as they come to everyone, but if you learn from them what they have to teach, if you let them refine your principles rather than shatter your confidence, they will prove to be the most valuable tuition you ever paid. Thank you for your attention to these matters. I hope you'll give them the serious consideration they deserve.